So what we're going to do first, before we jump into the new material for chapter 3, I want to just do a quick overview about what we covered last week. So last week was a bit of an introduction, and we said that when you're filing your tax return, the first calculation that you need to do is net income for tax purposes. And then after you calculate net income for tax purposes, the second calculation is your taxable income. And there were sort of special rules as to how you calculate net income for tax purposes. So why don't you just sort of go through a simple example on this first page here before we jump into the new material for chapter 3. So net income for tax purposes is the first calculation that we need to do. So let's say we have the 2024 taxation year, and let's say that at the beginning of the year, this taxpayer has a $2,000 non-capital loss carryover. Now, we talked a little bit about loss carryovers last week, and we said that a non-capital loss carryover basically means that there was certain types of losses that we couldn't use up in a particular year. So a non-capital loss carryover can be carried back 3 years, and we can carry it forward 20 years. And we can use it in those other years to offset any type of income. Now, so this particular taxpayer has a 2,000 non-capital loss carryover that's available to them at the beginning of the 2024 year. The other type of loss carryover that we talked about was a net capital loss carryover. Net capital losses can be carried back 3 years, and they can be carried forward indefinitely. But non-net capital losses can only be used to offset taxable capital gains. And so net capital losses are stemming from a year where you have more allowable capital losses than taxable capital gains. And so you can't use them all in that year. So they become a net capital loss carryover. So this particular taxpayer has a $2,000 non-capital loss carryover at the beginning of the year. When they're going to file their tax return, the first thing they need to do is calculate net income for tax purposes. And net income for tax purposes must either be positive or nil. You cannot have a negative amount. And we follow this formula from last week where we start off with 3A, we add 3B minus 3C, and then minus 3D. So let's just quickly review what's included in each of these components. When we're talking about 3A, we include positive amounts of net employment income, business income. So if you're a sole proprietorship, you include the business income if it's positive in 3A. Any property income. Property income would be passive income such as rental income, interest income, dividends, royalties. Also, you would include social assistance, workers' compensation board payment, any sort of pension income. So if you are withdrawing from your RRSP, that would be considered pension income. If you're collecting CPP, Canada Pension Plan, you include that in your calculation as well. And also any spousal support that is received. So those are all amounts included in 3A. So let's just say for argument's sake, this individual has net employment income of, let's say, $62,000. Now, today we're going to focus on how to calculate net employment income. But for this simple example, let's assume that that amount is given to us. Then we move on to 3B. 3B is the excess of your taxable capital gains over your allowable capital losses. And we said that 3B must be a positive amount. It cannot be negative. So 3B would either be positive or zero, and it stems from the disposition of capital assets. So when we're looking at 3B, we're looking at gains and losses from the sale of capital assets. And so capital assets are any assets used that you purchase to generate income. So that could be, for example, shares. A lot of individuals buy shares hoping to receive dividend income. And eventually, if they sell the shares, they want to sell it for more than they bought it for, they would have a capital gain. If they sold it for less than they bought it for, they would have a capital loss. So let's say that this individual sold some TELUS shares. And let's say that they sold the shares for proceeds of $2,000. So that's what they bought, or that's what they sold the shares for. From the $2,000 proceeds, we have to less what we call the adjusted cost base, what they bought the shares for. And let's say they bought the shares for $8,000. So in this example, they would have a capital loss of $6,000. Now, last week we looked at examples where there were some commissions as well. If they paid any commissions, they would deduct that from the calculation as well. But let's just ignore that for this simple example. Capital gains and capital losses are only 50% taxable and allowed. So even though the loss is 6,000, we have to multiply that by 50%. And this is going to give us what we call our allowable capital loss of $3,000. Now, remember, 3B must be positive or negative. It cannot be or positive or nil. It cannot be negative. So if that is the only transaction we have for 3B, the 3B amount will be 0. However, this loss that we cannot use up this year, this becomes a net capital loss carryover. Kind of what we talked about earlier. Any sort of capital losses that we can't use up in a particular year, we don't lose them. It just becomes a net capital loss carryover. We can't use it this year, but we can carry it back 3 years if we have any taxable capital gains, or if we don't, we can carry it forward indefinitely. Now, we will look at carrying losses over when we get to chapter 11. But let's just say that for this example, we're just focusing on the current year. This is the only sale they had of capital assets. So the 3B amount is 0. So 3A, we have the net employment income. 3B is 0. So the subtotal that we have down here is $62,000. So that's the 3A plus 3B. And then we move to 3C. And this is where we get into further deductions. If the taxpayer paid any spousal support, they could deduct it here. If they have any eligible childcare expenses, they could deduct it here. If they have any moving expenses, let's say they had to move for a job, they could deduct them here. Now we will learn how to calculate these amounts in chapter 9. So there's also RRSP deductions as well, which we'll learn about in chapter 10. And there's also this relatively new deduction called deductible CPP. Now we're going to see that next chapter. So I'll sort of leave that until chapter 4. But these are deductions we can take if we incur them to bring down our net income. So let's say for this example, this individual paid spousal support of $10,000. So we have 62,000 minus 10,000. The subtotal going into 3D is now going to be $52,000. Then we move on to 3D. 3D are losses from employment, business, and property. Now, it's very unlikely that you have an employment loss. The only time where you might have an employment loss is maybe you're a salesperson and you just started with the company at the end of December. And because you're a commission salesperson, you had to incur a bunch of expenses, for example, maybe advertising, promotion. And so that might be the rare example where you might have an employment loss, but most of the time your employment income is going to be positive. Now you could have a business loss or you could have a rental loss. So those are quite common. So let's say in this example, this individual has a business loss of 7,000. Now they have to use that loss this year to bring down their income. They don't really have a choice. Obviously, if they can't use it all this year, they can carry it over. But because they have a subtotal of 52,000, they're able to use up all 7,000 of that loss this year, and that's going to bring their net income down to 45,000. So this is sort of how the way tax software is programmed. Even though on tax software, when you use it, you don't see all these 3A, 3B, 3C, 3D. That's the way that the tax software has been programmed to make sure it follows these rules. So net income for tax purposes is the first total that is important on your tax return. Now, you're not taxed on that amount. Rather, you're taxed on your taxable income. And so how do you get from net income to taxable income? Now, a number of these deductions we're going to sort of see later on. one of these deductions relates to stock options, which we're going to talk about in chapter 3 today. And then remember social assistance and WCB. We said you had to include social assistance and WCB in 3A, but the government basically says we want you to include it in your net income, because your net income is all the income that you earned for the year, but we're going to allow you to deduct it when you calculate taxable income. And the reason for that is that if you're on social assistance, you probably have very low income. And so the government says, well, we're not going to tax you on that. So you include it, but you get to deduct it when you calculate taxable income. WCB, Workers' Compensation Board, you got injured on the job out of no fault of your own. You're not working, you're collecting WCB benefits, Workers' Compensation Board. You include it in your income, but once again, because you're not working, you're injured due to no fault of your own, we'll let you deduct it when you calculate taxable income. So those amounts will offset one another. But the reason that they're included in net income is because the government wants to know what is your sort of total income for the year. That's your net income for tax purposes. And net income for tax purposes, even though you're not calculating your taxes on that subtotal, it is used quite often to see if you qualify for certain government benefits. So when we went through COVID and they were giving sort of COVID benefits, they were looking at the net income for tax purposes that was reported on the individual's tax return, not the taxable income, to determine if they qualify for those government benefits. So this individual has net income for tax purposes of $45,000. And one of the things they can deduct now is this non-capital loss. Remember this non-capital loss that they had at the beginning of the year, which stemmed from an earlier year? If they want, it's not mandatory, it's discretionary, they could deduct that $2,000 non-capital loss here, and that would bring their taxable income down to $43,000. And so we're going to learn more about these deductions when we get to chapter 4 and chapter 11, how to get from net income to taxable income. But that's sort of a simple example illustrating how we calculate net income and then how we further calculate taxable income. Any questions about this simple example? Now, once you calculate taxable income, you calculate your federal and provincial tax payable. Now remember, there's provincial tax too, but because the provincial tax rates vary from province to province, we're just going to focus on federal tax payable. And remember those rates tables we looked at on last week? You would just sort of use those rates table to calculate your federal tax payable. After you calculate your federal tax payable, then you look at whether there's any tax credits that you qualify for that for. We'll see that in chapter 4. That will reduce your overall federal tax payable. After you minus your federal tax credits, you minus all the taxes that your employer took off your paycheck. If you paid installments, you minus those as well. And that's going to determine whether you have any more income tax owing or whether you will get a refund. So that's sort of a really brief example and overview of what we focused on last week when we calculate net income for tax purposes and also taxable income. And I wanted to just sort of do that quick review before we jump into the material for chapter 3. Any questions before we jump into the chapter 3 material? So for chapter 3, we're going to focus on calculating net employment income. And that's the amount that we include in 3A when we calculate net income for tax purposes. Now, generally, for most employees, you get your T4 slip and you just include that amount on your tax return. But we're going to sort of talk about things that get added to your employment income and also things that get deducted from your employment income. Now, of course, you include your gross salary. You would include things such as commissions, any bonuses that you get. We're going to talk about stock option benefits and automobile benefits in detail, but you also have to include non-cash gifts over 500, and we'll talk about that in more detail as well today. Let me just sort of go through a simple example. I want to just sort of show you the difference between your take-home pay versus what your net employment income would be for tax purposes. So let's just sort of go through a simple example. So let's say you're working part-time for a company and you have gross salary of, let's say, $9,000. And let's say you also get a bonus from this company as well, and that's $1,000. So both of those amounts, the bonus and the gross salary, those would be both included in your net employment income. So that's really easy to understand. When you work for a company, you get deductions for EI and CPP, and you also get deductions for income tax. So before you get paid, they're going to take off deductions for EI, they're going to take off deductions for CPP. I'm just making up some amounts here. And then they're also going to take out some deductions for income tax. Now, these amounts, the EI and CPP, those are tax credits. So we're going to see that in chapter 4. So it doesn't reduce your net employment income, but they become what we call tax credits. So you will get credit for them, but they don't reduce specifically your net employment income. The deductions that you get for tax, that basically just reduces your payable amount. So remember we said you figure out your federal tax payable, including your provincial tax payable, minus your tax credits, and then you minus all the taxes that has already been withheld by your employer. So that's where the $500 would come in. There's also some other things that could happen as well. Let's say you belong to a company pension plan called an RPP. RPP is called a registered pension plan. And that's basically set up by the company. Now, usually with an RPP, there's an amount that you contribute, and there might be an amount that your employer contributes. So let's say that you contribute $1,000. So they take it off your paycheck. You belong to this company pension plan, and you deduct $1,000, you contribute that amount, but they take it off your paycheck. And so that actually reduces your take-home pay. Let's say in some pension plans, your employer will make a contribution as well. Let's say your employer contributes $1,000 as well. The amount that your employer contributes, there's a question, is that a benefit that is taxable to you, the employee? And the way the Income Tax Act works is that this is not a taxable benefit. So I just want to sort of explain why you get to deduct the amount that you contribute, and the employer puts in an amount that becomes part of your pension plan, but that's not a taxable benefit. The government of Canada is trying to encourage Canadians to save for retirement. And so if we go back to the first page here, that's why when you put money into an RRSP, you get a deduction. You get a 3C deduction. Now there's rules as to how much you can contribute. We'll see that in chapter 10. If you contribute money to a company pension plan, this $1,000 here that you contribute, you also get to deduct that from your net employment income. So it encourages you to put money into the company pension plan, because if you do, the amount that you put in that's taken off your paycheck gets deducted when you calculate net employment income. Now, the amount that your employer contributes, if you think about it, that is basically extra money that you are getting put into your pension plan by your employer. So the logical thinking would be that, yes, that should be taxable to you because you're getting this extra $1,000 put in by your employer into your pension plan that will become yours when you take it out when you retire. But again, the government wants to encourage Canadians to save for retirement, so they make the employer contribution not a taxable benefit. So if we just sort of look at sort of these calculation here, we'll see that your sort of take-home pay after all these deductions is going to be $8,000. But the amount that you include for tax purposes, your net employment income for tax purposes, that you include in 3A, that's going to be $9,000. So a little bit different between what your take-home pay is and your net employment income, but I just sort of lay the foundation as to how this calculation is done and the fact that there are differences between what you take home versus what your net employment income is. Now, there's other things that can be added as well. So I want to just sort of talk about some other things that can be added as well. When we look at net employment income, there's also what we refer to as taxable benefits. Taxable benefits are things that get added to your net employment income. There are these amounts that we're going to be looking at in detail. Automobile benefits. There's a stock option benefits. And then there's this one called non-cash gifts for the year over $500. So those are sort of three things we're going to focus on today: automobile benefits, stock option benefits, non-cash gifts for the year over 500. And we're also going to look at rules with respect to bonuses. So those are going to be the four main things we're going to focus on today. Any questions before we jump into the next section? So when I talk about these non-cash gifts over 500, let me just erase that. That was up there. In your textbook, on these pages, 132, 133, they talk about gifts, rewards, and long service awards. And it's just covered over 2 pages. But these rules are really good to know. What it says is that there is this $500 annual exemption for non-cash gifts. And so what do we mean by non-cash gifts? You know, maybe a gift basket, maybe some, you know, could be maybe like a nice pen, for example. Often employers might give sort of gifts such as, you know, sort of mugs, clothing, for example, as non-cash gifts. So there's this $500 annual exemption for non-cash gifts. The rule also says that you would also ignore gifts of immaterial value. So for example, t-shirts, maybe just sort of a company coffee mug. So I probably should take coffee mugs out here because that would be considered immaterial. But let's say you got a nice wine glass set. That might be something that would be considered a non-cash gift. But anything that is sort of immaterial, you go to a company picnic, every employee gets a t-shirt. You start a new job at a company, they give you a coffee mug with the company logo. That would be a gift of immaterial value. You can just sort of ignore that altogether. And then there's a rule about what we call near cash gifts. Near cash gifts are, for example, a Visa gift card. It basically is the same as cash. Near cash gifts and cash gifts are always taxable. So if you were to get a cash gift, or let's say a Visa gift card, which you can basically use just like cash, those are always taxable. That is not included in this $500 exemption. Now, there's a specific rule with respect to gift cards. So let's say you get a gift card from, let's say, Amazon. Is that considered a non-cash gift, or is that considered a near cash gift? And so what I did was I kind of just cut and paste this from the textbook. It's over those 2 pages that I mentioned. And this is sort of where CRA has a policy that they follow. And so I'm going to just sort of highlight these points here. Before, gift cards were considered near cash, meaning that it was always taxable. Now the CRA has said if certain conditions are met, gift cards and gift certificates are treated as non-cash gifts eligible for the $500 exemption. But there's 4 conditions that have to be met in order for them to be treated as non-cash. The first rule, the gift is provided for a special occasion. So it has to be for a special occasion, someone's birthday, for example. The second condition, the card is preloaded with money, so a $50 gift card, and can only be used to buy goods and services. You cannot redeem it for cash, so it must be used to buy goods and services from that retail store. The third condition, it cannot be converted to cash. So they specifically say that the gift card that you get cannot be converted into cash, and the employer must maintain a log to track all the gifts that they give to all their employees, the date, the reasons, the amount, and so forth. So if those 4 conditions are met, then the gift card can be treated as non-cash and can be included in that $500 exemption. So I just wanted to sort of go through that because that is something that is relatively new. If you look at the date, that policy that the CRA introduced came out at the beginning of 2022. And so it sort of tells you that as long as those 4 conditions are met, you get a gift card, it can be included in the $500 exemption. And as long as you don't exceed the 500, you don't include that as a taxable benefit. Any questions about the gift card discussion? Now, when you read these pages, 132, 133, you'll see that there's a separate, what we call long service award. The separate long service award, or sort of is called a long service anniversary award. And it basically says it's up to $500 every 5 years, provided the gift is non-cash. So quite often employers will give employees long service anniversary awards. You've been with the company for 5 years, you get a small gift. After 10 years, you get another gift, provided it's every 5 years and not more than that, and provided it does not exceed 500 and the gift is non-cash, then once again, this would be exempt as well. There's also a separate discussion about performance-related awards. So when we talk about performance rewards, for example, you get an award for being the top salesperson, or you get an award being the employee of the month. So basically it's based on your performance, even though it could be non-cash or it could be non-cash. Performance rewards are always taxable. So top salesperson, even though it's a non-cash gift, it will be always taxable, not included in the $500 exemption. So I just wanted to sort of go through that because these are things that typically employees see quite often when they work for an employer. And to reinforce what we just talked about, I want to go through this exercise together. Now, remember with the exercises, the solutions are in your study guide. So the self-study problems that I posted on eLearn, all those solutions are in your study guide. Same with these exercise solutions. The exercises are in the textbook when you're reading them, but the solutions are in your study guide. So let's go to this question here. Exercise 3-3. And let's just sort of think about whether or not these amounts would be taxable or not. So Jeffrey's employer provides him with a number of gifts and awards. We're told that the Amazon gift card must be used for online purchases, and the card is not convertible to cash. And so we need to sort of determine whether these items that he receives are taxable or not. So let's start with a t-shirt. So what did we say about the t-shirt? If you remember, we said that this would be considered immaterial, so not taxable. So that's fairly straightforward. The birthday gift, the gift card from Amazon. So because it can only be used for online purchases, it cannot be converted into cash. It's for his birthday, a special occasion. That can be treated as non-cash, but is only up to $500. So what we'll do is we'll add that amount to this section here. So it is non-cash, but whether it's going to be subject to tax or not, we have to add up all the non-cash gifts to determine whether or not any amount will be subject to tax. The next amount is the reward for exceeding the sales target. So that reward is $400. Now, this is what I mean by performance related. Because this is performance related, the entire amount is taxable. So he would have to include that $400 in calculating his net employment income. So it's performance related because the reason he got it was because he exceeded his sales target. And once again, if you have any questions, just stop me or type your question into the chat. The 10-year anniversary award, that was a Seiko watch. And so that amount is that separate long service anniversary award. So that $275 watch, so it's under $500. So it would be not taxable. So there's that separate long service anniversary award up to $500 every 5 years. It's non-cash, so not taxable. The wedding gift, crystal vase for $300, that would be part of the non-cash gifts. So we're going to add the $300 here. And then we have the personal fitness award, tickets to a sporting event. Now, I need to sort of clarify this. This is not related to his job. It's not performance related. As we saw above, he's probably is in sales because he got a reward for exceeding his sales target. This is probably some sort of maybe employee sort of contest. Maybe they had a contest about who can achieve a certain fitness level. So it's just sort of an informal contest. It's not performance related to the job. It's just sort of a friendly, competition with employees. So this would be an example where this would be a non-cash gift. It's not performance related because it's not due to his day-to-day job duties. It's just some sort of fitness contest that maybe the employees had. So this 250 would be added to the non-cash gift total. And then the holiday season gift is a gourmet food basket, also a non-cash gift. So we add that 150. And when we add up the total there, that's a total of 775. So what we would do then is minus the first 500, and it would only be the 275 that would be taxable. So in this question, he would have to include 275 in his net employment income and also $400 in his net employment income. The first 500 of these non-cash gifts are not taxable. The t-shirt is immaterial, not taxable. The long service anniversary reward, also not taxable because it's non-cash under 500. Any questions about this discussion on gifts and awards?
What if I don't know the exact price of the gift?
So I mean, the CRA just basically just sort of uses what is sort of fair market value. They might just look online and figure out, okay, if you were to buy this at a store, what would the cost be? So if the CRA ever did an audit, that's probably what they would do. If the employer couldn't provide a receipt to prove what the amount was, then the CRA might just look online and figure, okay, if we were to just to buy this during the year, what would be sort of the average cost? And if you're ever in doubt, just ask the employer. The employer would get a deduction because these are deductions that your company gets when they're buying these gifts for employees. They would basically be part of their sort of expenses. So your employer would have basically a receipt for what they bought it for. So you could always ask your employer or your payroll officer as to what the amount was when they bought it. Does that answer your question?
Yes, thank you.
You're welcome. Any other questions before we move on? So what we're going to do next then is we're going to talk about bonuses. So there's this rule about bonuses as to when you include it in your income. Now I just sort of draw this simple diagram here. Corporations always drawn with a rectangle, individuals drawn with a circle. So we have this corporation and we have this shareholder here. So the shareholder owns shares in this corporation. And let's say this shareholder is also an employee. So it happens a lot with owner-managed companies. They incorporate a company, but they're also an employee. Let's say we get to the corporation's fiscal year end, which is December 31st, 2024. And let's say for this employee, who's also the shareholder, they declare this $20,000 bonus. So the corporation will get to deduct this bonus in 2024. So the employee, who's also the shareholder, and this applies to any employee, not just shareholders, but this happens a lot with tax planning for owner-managed companies. So this company declares a bonus because this employee did really, really well this year. And the bonus is for $20,000 and it relates to the 2024 year. So the company gets to deduct $20,000 when they calculate their income for 2024. Now, there's a rule that says if this $20,000 is paid by the 179th day from the fiscal year end, the employee doesn't have to include it until the year they receive it. And this is sort of what I have up here. So the wording is right here. So this company's fiscal year end is December 31st, 2024. The 179th day from that day is going to be June 28th, 2025. So provided that the bonus is paid by June 28th, 2025. So let's say it was paid on June 28th, 2025, then this employee would include in their 2025 year. And this is sort of what we refer to as tax deferral. The corporation will get the deduction in 2024, going to reduce their income this year, and so they pay less tax. But the employee doesn't have to include it as long as it's paid by the 179th day of the company's fiscal year end. The employee doesn't have to include it until the year they receive it. So this is planning that's used a lot for owner-managed companies. Corporation gets a deduction now. Employee doesn't have to include it until next year. So there's this tax deferral. These rules are summarized in your textbook in this figure here. So what we just talked about was what's referred to as the standard bonus, paid by the 179th day of the employer's taxation year end. If that is the case, the employer deducts when accrued, so in the year that they declare the bonus, but the employee includes when received. So the employer will deduct it on an accrual basis, but the employee will include it on a cash basis. Now, what if it's outside of these 179 days? Let's say it's more than 179 days, but it's prior to 3 years from December 31st of the year that the bonus was earned. The employer would deduct when paid, employee would include when received. If it falls within sort of this time frame here, both would then record it on a cash basis. But what if it extends beyond the 3 years? Then both would be done on an accrual basis. An accrual basis means when the bonus relates to. If the bonus related to 2024, then the employer could deduct it in 2024. The employee would have to include that amount in 2024, even though it's not going to be paid for more than 3 years. So these are the rules that are in place, and it's just basically trying to prevent companies and their employees from coming up with sort of sneaky ways to try to get the deduction for the employer now, but delay the inclusion for the employee until a later point in time. Most of the time, you're going to fall into the standard bonus here. But the reason that they have these other two sets of rules is, once again, trying to overcome situations where employers and employees are trying to sort of maximize sort of their tax benefits by sort of delaying when the employee has to include it in income. So those are the rules we're going to look at, and we're going to sort of look at it with respect to this question here. So we have this company, Marquee Limited. They're a Canadian public company, and their taxation year is November 30th. So that's sort of important because companies can have sort of any fiscal year end. It doesn't have to be December 31st. So this company has a November 30th year end. And for the year ending November 30th, 2024, they're going to declare bonuses for each of the following 4 executives: Chico, Zeppo, Groucho, and also Harpo. And the bonuses were declared on November 29th, 2024, so by that fiscal year. And each of these executives is going to sort of have a different payment date for their bonus. Now, the key things we have to look at is, when is the 179th day? Because remember, the bonus must be paid by the 179th day. So from the fiscal year end. So what I've done here is looked at their fiscal year end. Their fiscal year end is November 30th, 2024. Now, the 180th day that's too late. So it has to be before the 180th day. But if I was to figure out the 180th day, basically December is 31 days, January is 31 days, February is 28, March is 31, April is 30. And so that's going to give us 151 days. And so to get to 180 days, we need an additional 29 days in May. So the 180th day would be May 29th, 2025. So if it has to be paid by the 179th day, that's going to be May 28th, 2025. So, it's usually going to be about 6 months, but because of months with 31 days, it's going to be usually just under 6 months from the fiscal year end. So that's the 179th day, May 28th, 2025. The other relevant date, if we go back to the chart here, other than the 179th day, the other relevant day is prior to 3 years after December 31st of the year in which the bonus was earned. So even though this company has a November 30th year end, for this 3-year time frame, we go to December 31st of that year and then add 3 years. So we start with December 31st, 2024. We add 3 years, and so that 3-year time limit is December 31st, 2027. So we have the 179th day here, and then we have that 3-year time frame right here. So those are the relevant dates that we have to look at when we're looking at which of those following rows each of these bonuses will fall into. Any questions about those dates? So let's look at Chico. Chico is the CEO, and he doesn't need the money right away, so his bonus will be paid on March 31st, 2029. So let's look at Chico. Paid March 31st, 2029. And so that's going to be after the 3 years. So if it's after the 3 years, where do we fall into? After the 3 years, we fall into the salary deferral arrangement. Everything is going to be reported on an accrual basis, meaning when the bonus was declared. So what that means is the employer will get the deduction in fiscal year end, November 30th, 2024, everything on an accrual basis. And Chico would include in 2024 employment income. So once again, not many situations will fall into this salary deferral arrangement. The reason they have this rule is they're saying that you can't delay paying the bonus forever. If you delay it past 3 years from December 31st, then everything will be done on an accrual basis. Even if you haven't paid it, the employee will have to include it in the 2024 year. So these rules are meant more for prevention than actually having taxpayers follow them. So let's look at Zeppo. Zeppo's payment will be paid in January 2025. So this is going to be one where it fits into that standard bonus. So the payment's going to be for Zeppo in January 2025. And so that's within, or that's by the 179th day. So remember, the 179th day was May 28th, 2025. And so once again, if we go up to the chart here, this is going to be a standard. Employer will deduct when accrued, when it was declared. Employee includes when received. So we look to Zeppo. The employer will deduct in fiscal year end, November 30th, 2024. And then the employee, Zeppo, includes in 2025 employment income. So that's sort of that standard bonus we were talking about, where the company gets the deduction this year, but the employee doesn't have to include it until it's received, as long as it's paid by the 179th day. Let's go and look at Groucho. Bonus is paid on December the 1st. So it's after the company's fiscal year end, but it's still within the same calendar year. So December 1st, 2024. So this is again also by the 179th day. And so the same rules would apply. Employer would deduct in fiscal year ending November 30th, 2024. And Groucho would include when received, but it just happens to be in 2024. So he would include that in the 2024 employment income calculation. So if Groucho had waited until January 1st, 2025, then he wouldn't have to include that until 2025 employment income. And the last one we're going to look at is Harpo. Harpo's bonus will be paid on September the 1st, 2025. So this is one where it's after the 179th day, but before the 3 years. And so if we go back to the diagram up above, this is going to be that middle row there, the other bonus, more than 179 days, but prior to the 3 years. In this example, everything would be recorded on a cash basis. So this is sort of that other category, other bonus. So because everything is on a cash basis, the employer then would deduct when paid September 1st, 2025. That will be their fiscal year ending, November 30th, 2025. And the employee, Harpo, would include in 2025 employment income. So that's sort of the first rule we're looking at in detail. as it relates to bonuses paid to employees. Any questions about that problem? One of the other taxable benefits that's quite common is automobile benefits. So let's say that you get use of a company car. You get use of a company car, you get to and at the end of the day, you get to drive home, use it on evenings and weekends when not working. So there is a taxable benefit. So this is sort of different from if you go to work, you take the company car out for the day to visit clients, you return to the office, you leave the company car there, and then you go home. This is a situation where you get use of a company car, but you get to take it home with you. And so usually this might be just sort of executives of a company. They get to take the car home with them. They use it for employment purposes, but rather than return it to the company at the end of the day, they get to take it home with them. They can use it if they want on evenings and weekends. They don't have to, but there's the option to use it. Then there is a taxable benefit because if you think about it, then they don't have to buy their own car because they have this company car available. When it comes to calculating the benefit for using a company car, there's sort of two calculations. There's what we call the standby charge benefit, and then there's what we call the operating cost benefit. The standby charge benefit, it basically just means the car is available for standby. You drive it home, is available for evenings and weekends. You don't have to use it, but it's on standby. So there must be some benefit inherent to having the car there because you don't have to buy your own car. And the second benefit that we have to calculate is based on how many kilometers you drive it. And for 2024, it's 33 cents for every personal kilometer that you drive it. So how do we calculate these amounts? Well, the standby charge up above, there's two formulas. If the company owns the car, we use this formula. If the company leases the car, we use this one. And once again, this is only done if you get to take the car home with you and there's the ability for you to use it on evenings and weekends on your own personal errands. But what if you do get to take the car home, but you don't use it at all, or you use it very little? Then you get what we call this reduced standby charge. If your employment use is greater than 50% of all the kilometers driven, then you get this reduced standby charge because you're using it more than 50% for employment use, very little for personal use, then you get this reduced standby charge. And we'll go through these calculations together. If you qualify for this reduced standby charge, then your operating cost benefit can also be just 50% of your reduced standby charge. We just take 1/2 of the reduced standby charge, and that could be a better way of calculating your operating cost benefit than multiplying your personal use kilometers by 33 cents. So seems kind of overwhelming when you're looking at all these numbers and formulas here, but let's just sort of put this into a question. So we have this company, Kaplan Limited. They provide automobiles to their 4 senior executives, and the senior executives will use the cars for both employment and personal purposes. When the car is not being used, the company policy requires the automobiles to return to the company's premise. What that means is they can take it home with them when they're using the car for employment purposes. But let's say they are away for a month. So let's say they're away for a month on maybe medical leave. During that month, they have to return the car to the company's premise. They don't need to worry about the standby charge and the operating cost benefit for that 1 month because it's being returned to the company's premise. But in their day-to-day activities, if they're working Monday to Friday, they get to take the car home on evenings, they get to take the car home on weekends, so they can use it personally. Now, even though there's 4 executives, we're just going to look at 2. We're going to look at Sheldon first. And then we'll look at Jerome. And then what I'll do is I'll give you the answers for Barbara and Melissa, so you can do these other two on your own. So let's look at Sheldon. The car that Sheldon uses, the company leases. And the lease payment that the company pays is $1,100 per month. During the year, Sheldon drives the car 34,300 kilometers, of which 32,600 is for employment use. And so very little personal use. And the operating expenses averaged 33% per kilometer and paid by the company. So this one's a little bit of a red herring. The operating expenses are paid by the company. So it doesn't relate to Sheldon at all. If Sheldon had paid for some of the operating expenses, then that amount that he paid for could reduce the amount of the taxable benefit. But all they're saying is that all of the operating expenses, all the gas, all the repairs, that's paid for by the company, not by Sheldon. Now, Sheldon's car is available to him for 8 months during the year. So for the other 4 months, he does not have use of the car, but for the 8 months, he is able to take the car home with him. He can drive it on weekends and evenings, and he drove it for 1,700 kilometers during those 8 months for personal use. So the first thing that I would do when facing this type of question is figure out the percentage employment use. So he drove the car 32,600 kilometers for employment use. The total kilometers was 34,300. So that's 95%. The reason we do that is we want to make sure that if it's over the 50% threshold, then he's eligible for the reduced standby charge. So if you drive the car for greater than 50% employment use, then you'll qualify to use the reduced standby charge. That's going to reduce the amount you have to include as a taxable benefit. So what we're going to do first, though, is calculate the full standby charge. So we have to calculate the full standby charge before we can calculate the reduced standby charge. And this is where we go to the formula, and it depends on whether the car is owned or leased. In this example, the car is leased. So let's look at this formula here, 2/3 times the lease payments for the year. Now, if there was GST, PST, we include that amount. But if the lease payment included insurance, we would deduct that from the lease payments for the year. Now, this is the lease payments for the entire year, not just for the 8 months that he was using the car. Is kind of implicit in the question that the company is going to lease the car throughout the entire year, but he only gets use of it for the 8 months. During the other 4 months, of course, other employees may be using it. So the lease payments are for the entire year that the company makes the payment on the lease, not just for the 8 months that he got to use it. And then we multiply it by this fraction of days available divided by 30, divided by days leased divided by 30. What these amounts are trying to do is trying to estimate the months available over the months leased. So if you think about what if the car was available for 365 days? If you take 365 divided by 30, you're going to get 12.17, but it says round it. So you round it to the nearest whole number. So basically it's just trying to get how many months was it available divided by how many months was it leased. So that's what those two numbers are. In this question, we're given the exact amount of months available, so we don't have to worry about it. So we go down here. The way we would calculate this is because this car is leased, we take 2/3 times the lease payments for the year. The lease payment per month was 1,100, so we multiply that by 12. And then we multiply it by the months available divided by the months leased. It was leased for the whole year, so it would be 12 months. So just sort of work through that calculation. So 2/3, if you're using Excel, it might be a little bit easier. But if you work through that calculation, we're going to get 5,866.67. So that would be the full standby charge. If his employment use was not greater than 50%, he would have to include that full amount, 5,866.67, in his net employment income. But because he qualifies for the reduced standby charge, we basically take the full standby charge, 5,866.67, and then we go to the formula above, the reduced standby charge. We take the full standby charge, the 5,866.67, times this fraction. Personal use kilometers divided by 1,667 per month times each month of availability. What this denominator is saying is that if you use it more than 1,667 kilometers per month, we're not going to make you pay more. So that's why this numerator says cannot exceed the denominator. Let me just sort of put this into our question here, and it might make a little bit more sense. So Sheldon uses the car for personal use 1,700 kilometers. So what we would do then is times the fraction of 1,700 kilometers divided by, and I'll put this sort of in brackets as well. It's 1,667 per month times months of availability. The car was available to him for 8 months. And so let me just sort of write this out. So it's going to be 5,866.67 times 1,700 kilometers personal use divided by 13,336. And when you work through that, you'll see that this reduced standby charge is only $748. I'm just going to put this on another page here so we can talk about this. So that is the reduced standby charge. It gets reduced all the way from 5,866.67 all the way down to 748. And the reason for that is because of this here. When we look at that there, what it's saying is that there's sort of a threshold. If you drive it a lot for personal use, even though it's greater than 50% employment, if you drive it a lot for personal use, then your numerator is going to increase. So if you drove it, let's say 5,000 kilometers personal use, is going to be a larger taxable benefit. 5,866.67 times 5,000 divided by 13,336. His taxable benefit would be 2,000, basically 100, basically 2,200. So the more you drive it, the greater your numerator will be, and so the greater your taxable benefit. But what it says is that your numerator cannot exceed the denominator. So that denominator is based on that 1,667 that's set by the government times the months of availability. So let's say that he drove it, let's say 15,000 kilometers personal. They're not going to make you increase the standby charge. What it says is that the numerator cannot exceed the denominator. So in a case it does, we'll just leave it at the regular standby charge. So if your personal use kilometers exceed the denominator, we're not going to increase the standby charge. We'll just reset it to what the full standby charge was. Any questions about how that reduced standby charge is calculated? So in this example then, his reduced standby charge that he has to include in his net employment income is only going to be $748. So that is his reduced standby charge. Now there's also the operating cost benefit. So the operating cost benefit, because he drove the car greater than 50% for employment use, his operating cost benefit is going to be the lesser of two amounts. The first amount is that 33 cents that we saw times the personal kilometers, 1,700 personal kilometers. So the first amount is going to be 561. And the second amount is just going to be 1/2 of the reduced standby charge, which is 748. And so that's going to be 374. So generally it's going to be 33 cents times your personal kilometers driven. But if you qualify for the reduced standby charge, then your operating cost benefit will be the lesser of these two amounts. And the lesser of these two amounts is going to be the 374. So that would be included in his net employment income as well. Now, if he reimbursed his employer for using the car, that would reduce his taxable benefit, but there's no mention of that. So in this example, Sheldon would have to include 1,122 in his net employment income. That would be considered a taxable benefit for him having use of the company car for personal use. Any questions about Sheldon's calculation? So let's have a look at Jerome. And the reason I picked Jerome is that this is going to use the formula for when the car was bought by the company. So with Jerome, the car was bought by the company for 74,200. It was available for 10 months. He drove it 93,000 kilometers, 24,000 for employment, 69 for personal. So drove it a lot for personal. And all the operating expenses were paid by the company. So once again, first thing I would do in this type of question is figure out the percentage employment use. And so for Jerome, he drove it only 24,000 kilometers for employment. Total was 93,000. And so this is 25.8%. And so in this one, there's going to be no reduction. So he's going to get the full standby charge. And now we have to look at the formula where the car was bought by the company. So when the car is bought by the company, we take 2% times the cost of the car. And once again, days available divided by 30. This is just trying to figure out the months available. So once again, if the car, let's say, was available for, let's say, 100 days, you would take 100 divided by 30, and you would get 3.3. That will be rounded down to 3 months. If you were told it was available for 100 and, let's say, 15 days, divided by 30, it would be 3.8. That would be rounded up to 4 months. So that's why they have days available divided by 30 rounded, but basically they're looking for the months of availability. So the car that is owned calculation is fairly straightforward. 2% times the cost of the car. And the cost of this car was 74,200 times months of availability. It was available for 10 months. And so this taxable benefit would be 14,840. And that's a lot. And one thing I want to just sort of point out, I'm just going to highlight this number first. These formulas, whether it is leased or whether the car is owned, is done in such a way that the more expensive the car, the higher the taxable benefit. So let's look at what we just did for Jerome. The cost of the car was 74,200. If the company bought a less expensive car, maybe worth 25,000, and Jerome was given that car to use, the benefit would be a lot less because it would only be based on 25,000. So the formulas are set in such a way that it tries to discourage companies from buying very expensive cars for their employees to use because the taxable benefit to the employee will be a lot higher. Same with lease payments. For Sheldon, the lease payments were $1,100 per month, which is quite high. If the car was maybe a more modest car, the lease payments per month may only be $300 or $400. So the benefit would be a lot lower if it was a less valuable car. So with Jerome, no reduction to the standby charge. And so what that means is that the operating cost benefit, we don't get the lesser of because he doesn't get the reduced standby charge. It's just going to be 33 cents times the personal kilometers driven, which was 69,000 kilometers. And so the operating cost benefit is going to be 22,770. So once again, the more you drive it personally, the higher the operating cost benefit will be. And I just want to put this reimbursement amount here because in some of the questions, the employee does reimburse the employer for using the car. That would reduce the taxable benefit because the employee made some payment to the employer. But in this example, there was none. So the taxable benefit is going to be 37,610. So once again, quite a lot. And the reason is because Jerome used the car 69,000 kilometers for personal use. Any questions about those two calculations? Now, we didn't do Barbara and Melissa, but I'm going to give you the answers for both of these. The taxable benefit for Barbara is 13,800. The taxable benefit for Melissa is 51,370. So you can just sort of work through those two on your own when you're going through getting ready for midterm number one or doing some studying. You can just double check to make sure that you do these two employees and that you get 13,800 and 51,370. So that's automobile benefits. We're going to start stock options, and then we'll probably take a break closer to 7:30. But let's talk a bit about stock options. Stock option, I'm just using some abbreviations here, allow the employee the option to purchase a company's shares at a predetermined price. So if you think about stock option, it gives the employee the option to buy shares in the company that they're working for. And sort of there's a couple of reasons why stock options are used by employers and employees. The employer, so I'm just going to use ER, short for employer, may issue stock options rather than pay cash bonuses in order to preserve cash. So sometimes an employer, rather than pay a cash bonus, may issue stock options because they want to give the employee some sort of reward or bonus, but they don't want to pay cash because they want to preserve the cash to use in their operations. So they might give employees a stock option or employees. So employee, the benefit as well is that the employee may decide to purchase the stock and want the stock price to increase, thus focusing their duties and decisions on the long-term success of the company. So if you are an employee and you decide to buy the stock, obviously you want the stock price to increase. And so in your performance of your job, you may be making decisions that will increase the long-term success of the company, thereby increasing the stock price in the future. So sort of benefits employers and also in the way that their employees will act once they become shareholders of the company. What I want to do is sort of walk through a simple example about stock options. And then after the break, we'll go through a question from the textbook. So let's look at this example here. July the 1st, 2020, ABC Limited is going to grant Fran, the employee, a stock option to buy 5,000 shares in ABC for $10 per share. And at the time the stock option was granted, the fair market value was $8. So this is known as the grant date. July 1st, 2020. On July 1st, 2020, there are no immediate tax consequences. So the option is just granted to Fran. She doesn't have to buy the shares if she doesn't want to. So there's no immediate tax consequences. But on this grant date, we do have to measure whether the option was issued in the money or not in the money. Now, most of the time, the fair market value is going to be lower than the option price, what the employee has to pay. And the reason for that is that they want the employee to sort of work towards increasing the price of the fair market value of the shares. And sort of they have to sort of work and make sure the company is successful to increase the fair market value before they're going to exercise a stock option. Otherwise, they're not going to exercise a stock option if they can buy it cheaper on the stock market for $8. So on the grant date, there's no immediate tax consequences, but we do have to measure whether the option was issued in the money or not in the money. So in the money means the option price, what the employee will have to pay, is below the market value. And so that's very rare because if you grant an option in the money, it doesn't give the employee any incentive to try to make the company more successful because they can just buy the shares on that day and sell it later on that day for a higher amount. So most of the time, the options will be issued not in the money, but we have to measure that when the option was issued. So in this example, the fair market value was $8. If Fran wants to buy the shares, she has to pay 10. So it is not in the money, which is standard. So standard will be not in the money, but that measurement is done on the date the option is granted. So this option was not in the money. Now, let's say next year on January 27th, 2021, Fran exercises the option and buys 5,000 shares. Now, this is the exercise date. And so Fran is going to buy 5,000 shares. And the price she is paying is the $10 per share. Because remember, the stock option gave her the right to buy the shares at $10 per share. But on the exercise date, the shares were trading for $15, which sort of makes sense, right? Because Fran would only exercise the stock option if the actual fair market value was higher than what she had to pay. Otherwise, she'd be better off buying the shares if she wanted them just on the stock market for the lower fair market value. So generally, employees will only exercise a stock option when the fair market value has gone above what their option price is. And you can sort of notice that there's a benefit here. She's only buying the shares for $10, but they're worth 15. So on the exercise date, we have to calculate this employment income inclusion. So this is measured on the exercise date being January 27th, 2021. And so this employment income inclusion, we take the number of shares times the difference between the fair market value and the price she paid, which makes sense, right? Because she got an immediate increase in value of $5. She only paid 10, but they're worth 15. So that increase of $5 per share times the 5,000 shares, that is an employment income inclusion of 25,000. This is included to her net employment income. Now, it may not have to be included in 2021, but we'll talk about that later. But we have to do the calculation on the exercise date because we're looking at the difference between what she bought the shares for on that date compared to what the fair market value was. And once again, you're never going to exercise the stock option unless the value of the shares is equal or more. So it's never happened that you would exercise it for when the fair market value is lower. Obviously, you would only exercise the stock option if the fair market value was higher or the same as what you have to pay for them. So we measure that on the date of exercise. Now, the shares then are sold a few years later. So on April 3rd, 2024, he's going to sell the shares. So I want to talk about what happens then when she sells the shares. When she sells the shares, there's going to be a taxable capital gain, hopefully, because hopefully she would have sold them for more than she paid for them. And she sells all 5,000 for $19 per share. So the way we calculate the capital gain is we take the 5,000 times the difference between the sales price 19 and what she paid for them. But it's not really what she paid for them, it's not the $10 because remember she paid 10, but she had to include this difference of $5 in her employment income. So because she was taxed on that $5 per share, her adjusted cost base is actually going to be $15, not 10. Even though she paid 10, she had to include that $5 difference up to $15 in her employment income. She's going to be taxed on that. So she's going to get that added to her cost base. And so her adjusted cost base is going to be $15. So in effect, she basically made $4 per share. So $4 per share times 5,000. That's going to be a capital gain of 20,000. And remember, only 50% of capital gains are taxable. So her taxable capital gain is going to be 10,000. So let's sort of talk about when these amounts would be taxed. We have this 25,000 net employment income that we measured in 2021 when she exercised the stock option. We have this taxable capital gain of 10,000, which we calculated when the shares were sold, and the shares were sold in 2024. So let's talk about this first example. Let's say ABC was a public company or not a CCPC. Now, we talked about CCPCs last week, Canadian Controlled Private Corporations, and I kind of mentioned briefly that the government usually gives certain sort of tax incentives to Canadian controlled private corporations. They want Canadians to incorporate their own small business. So if this company ABC was not a CCPC, there would sort of be no tax benefits. In this case, Fran would include the 25,000 in her net employment income in the year the option was exercised, which is 2021. So if ABC was not a CCPC, no breaks, Fran has to include that 25,000 in the year 2021 when she exercised the stock option. So that would be added to her net employment income. So her net employment income would increase by 25,000. And that would increase her net income for tax purposes. Now, you may remember at the very beginning of today's lecture, if I scroll back to page 1, your net employment income is included in 3A. So that 25,000 is included in 3A. That becomes part of her net income for tax purposes. But then there was this 50% employee stock benefit that's listed here. Some employees that have to include that 25,000 or whatever the amount is in their net employment income may qualify for this 50% deduction when they calculate taxable income. So how do we qualify for this 50% deduction? Is talked about right here. You qualify for that 50% deduction if either of these apply. If at the time the option was issued, the option price was equal to or greater than the fair market value. What that means is when the option was issued, it was issued not in the money. That's one way to qualify for a 50% deduction. The other way is if the company that gave you the stock option was a CCPC and you, the employee, held the shares for at least 2 years before you sold them, you would also qualify for the 50% deduction. But you don't have to qualify one way, not both. This is an or statement. So because the option was issued or granted not in the money, she qualifies for this 50% deduction. So what does that mean? Fran would include 25,000 in her net employment income, and that would increase her net income for tax purposes. She's going to get the deduction of 25,000 times 50%. So she's going to get this deduction of 12,500. So her taxable income will only increase by 12,500. This would all be in the 2021 year. And the reason she gets the 50% deduction is because the stock option was issued, not in the money. In the 2024 year, when the shares are sold, she would have to include the taxable capital gain of $10,000 in 3B when calculating net income for tax purposes. So this 10,000 taxable capital gain when the shares are sold would be included in 2024 in the year the shares were sold. So that's the timing if ABC was not a CCPC. Any questions about that example? Now, what about if ABC was a CCPC? If ABC was a CCPC, then everything would be delayed until the shares are sold. So the amounts would be delayed for inclusion in income until the year the shares are sold. So the year the shares were sold was 2024. So in 2024 then, if this was a CCPC, then in 2024 in 3A, she would include the 25,000 in her net employment income. In 3B, she would include the taxable capital gain of 10,000. So her net income for tax purposes would increase by 35,000. And then she would get that 50% deduction, because remember the option was issued not in the money. So she would get that 50% of 25,000. And so her taxable income would increase by 22,500. But this would all be in the 2024 year. And what you can see is that the overall increase to taxable income is the same, but the timing is different. If ABC was a public company or not a CCPC, 12,500 in 2021, and then 10,000 in 2024. So that's still 22,500. But if ABC was a CCPC, everything would be delayed until 2024. And so the overall impact to her taxable income is 22.5. Any questions for this example? So once again, some fairly complex rules when it comes to stock options. So it is 7:30 right now. I did sort of put this little blurb here about these new rules that came into effect a few years ago. I'm just going to cut this out and put that down here. These are these new stock option rules that came into effect in July 2021. What we'll do then is we'll take a break. And when we come back from the break, we're going to jump into assignment problem 3-8. So let's take a break and let's come back at 7:40 p.m. And if you haven't had a chance to read through this assignment problem 3-8, just give it a quick read through during the break. And I will see you back here in We're going to look at assignment problem 3-8, which is going to sort of help us, again, understand stock options. So we have this employee, Loretta, and she's worked for several years for this Canadian Public Corporation. And in September 2022, she's granted options to buy 2,000 of the company's shares at a price of 19. At the time, the shares are traded at 17. So this is sort of what we mean by the grant date. When the option is granted, we need to measure whether the option was granted in the money or not in the money. So on the grant date here, we're gonna work through part A, but under part A, I'm just gonna make a note here, 2022, this was the grant date. So there's no immediate tax consequences, but we need to measure if the option was granted in the money or not in the money. And this one was not in the money. And the reason it's not in the money is because she'd be better off buying the shares on the stock market for 17 rather than exercising the stock option for 19. So that's generally the situation that options will be granted, usually not in the money. So that's on the grant date. In February 2023, so the next year, when the shares were traded at $27, she bought 1,000 of the shares. So even though the option was for 2,000, often you don't have to buy all the shares all at once. So she bought 1,000 of the shares. And then the remaining shares she bought in December when the value was 32. And once again, her price was 19. In the following year, in 2024, the value of the shares had declined to $30, and she sold all 2,000 at the time. So for part A, we want to figure out what happens in 2022, 2023, 2024. And this is all when the company that she works for is a public company, so not a CCPC. So we know that in 2022, in the grant date, all we need to do is measure whether it's in the money or not in the money. There's no immediate tax consequences. In 2023, this is the exercise date. And on the exercise date, we have to sort of look at the increase in value that the shares have over what she paid for them. So why don't we go through this together? So the first 1,000 shares she bought, she paid 19, but the fair market value when she exercised the first option of first 1,000 was 27. So the value had increased by $8. So she only paid 19. The value fair market was 27. So she immediately got this increase of $8 over what she paid. And so that's going to result in $8,000. When she exercised the second 1,000 shares, the value was 32. She paid 19. once again, that's an increase of $13 per share. And so that's going to be 13,000. So the total is going to be 21,000 that she would have to include in 3A when calculating her net employment income. Now remember, this is a public company, so there's no delay. Everything has to be included in the year the option was exercised, which is 2023. So she would have to include 21,000 in her net employment income for 2023. But then we get the question about, does she qualify for that 50% deduction? When calculating taxable income. And remember we said there's sort of two ways to qualify. You either are granted the stock option not in the money. That's one way, which it was. The other way is if the company that granted you the stock option was a CCPC. Well, this is a public company, so we know we wouldn't qualify that way, but it's an or statement, so it doesn't matter. So as long as the option was granted not in the money, she will get the 50% deduction. So 50% of 21,000 is going to be 10,500. So the net increase to taxable income will be 10,500. So she includes 21,000 in her net employment income. That gets added to her net income for tax purposes. We get the 50% deduction. And so the net increase to her taxable income will be 10,500. So a lot of the questions will ask, what is the increase to net income for tax purposes? And what is the increase to taxable income? So the increase to net income for tax purposes would be 21,000. The net increase or the increase to taxable income would be 10,500. And then we move to the 2024 year. This is the year the shares are sold. And so when the shares are sold, we take the proceeds of disposition. She sells the shares for $30 each. Now she's selling all 2,000. So she's going to take 2,000 shares times $30 per share. And so the proceeds are going to be $60,000. And then we minus the adjusted cost base. Now, this is sort of where we have to figure out what was the fair market value on the exercise date. Because remember, she had to include this difference of $8 and this difference of $13 when she was calculating her net employment income. So for the first 1,000 shares, we're going to use an adjusted cost base of $27. And for the next 1,000 shares, we're going to use an adjusted cost base of $32. So the way we calculate this is we're going to take 1,000 times 27 plus 1,000 times 32. And so that's going to be her overall cost base. So basically 27,000 plus 32,000. And so her total adjusted cost base is going to be 59,000. So then the questions that sometimes come up is, what if she didn't sell all 2,000 shares? What cost would we use? Well, shares are known as identical properties. So we know that the total cost is 59,000. And if we divide it by 2,000 shares, then the cost per share would be $29.50. So if she didn't sell all 2,000, and we're trying to figure out what is the cost that we need to use, shares are identical properties. So even though she bought 1,000 shares at the beginning of 2023 and the remaining 1,000 at the end of 2023, they're identical properties. You can't distinguish them. They're not, different in any way. They're all the same. So then we use sort of this average cost of $29.50 if she only sold part of the 2,000, but she sold all 2,000. So we just minus the 59,000. And so her capital gain is going to be 1,000. Multiply that by 50%. So her taxable capital gain will be 500. And that's the amount she will include in 3B when calculating net income for tax purposes. Any questions about Part A? So 2 different years here, 2023, 2024. 2023, she has that net employment income inclusion minus the 50% stock option deduction. 2024 is when she realizes the capital gain, of which 50% is taxable. Let's have a look at Part B. Part B says, how would your answer change if the shares have been trading at $22 at the time the option was granted? So what Part B is saying is that if we go back to the question here, the only change for Part B is that at the time the option was granted, rather than it be $17, the shares were trading at 22. The difference here then is when the option was granted, it was in the money. So this is Part B of the question, where they change the fair market value when the option was granted. Rather than 17, it's 22. So when the option was granted, it was in the money because she could immediately exercise the option, buy the shares for 19, and immediately sell them for 22. That's why she's in the money. That's why the option was granted in the money for Part B. So for Part B, the difference would be then on the grant date, the option was issued in the money. So how would that change things? Remember we said that because this is a public company, the only way she can qualify for this 50% deduction is if the option was granted not in the money. So what would be the difference then in Part B? The difference then would be in 2023, again, her net employment income would increase by 25,000 or 21,000. So it's that same 21,000 that we got here, but the difference is that there would be no 50% deduction. So her taxable income, so both her net income for tax purposes and taxable income would increase by 21,000 because there's no 50% deduction because the option was issued in the money or granted in the money. And then the same would apply for 2024. The 3B taxable capital gain would be 500. So there'd be no change in 2024. The only change would be in 2023. Any questions about Part B? So then let's go to Part C. Part C says, how was your answers to both A and B change if the employer was a CCPC? And so once again, we're not going to go through what is a CCPC. That would be something you will learn if you end up taking the corporate tax course, BFIN 451. So in these questions, we'll be told if it is a CCPC or if it's not. How would your answers change? Let's go to Part A. If the option was granted not in the money and it was a CCPC, what would be the change? So let's look at Part C. Let's redo Part A. And so if it is a CCPC and it's not in the money, Basically, everything would sort of be deferred until the year the shares are sold. And so in that case, that would be the year 2024. So let me just put this on the next page here. That would be the year 2024. So in 2024, in 3A, we would include the 21,000. That was that net employment income inclusion. In 3B, we would include the taxable capital gain of 500. So the net income for tax purposes would increase by a total of 21,500. Because the option was issued not in the money, she would get the 50% deduction. And remember that 50% deduction is based on the 3A amount of 21,000. So that'll be deduction of 10,500. And so taxable income would increase by 11,000. Remember we said that it's just basically a timing thing. So because this is a CCPC, everything would be delayed until the year the shares are sold, which is 2024. The overall increase to net income would be 21.5. The overall increase to taxable income would be 11,000. But if we go back to part A here, we'll see that the overall increase is still 11,000. 10,500 in 2023, 500 in 2024. So the overall increase is still 11,000 to taxable income, but it's just that if it's a public company, that employment income amount is included in the year the stock option is exercised. But with a CCPC, everything is deferred until the year the shares are sold. And then it asks us to redo part B, assuming that this is a CCPC. So for part B, it is a CCPC, and the option was issued in the money. Similar thing, everything is deferred until the year the shares are sold. So once again, that's going to be 2024. But in this case, we also include in 3A the 21,000. In 3B, we also include the taxable capital gain of 500. So the increase to net income for tax purposes would also be 21.5. But remember we said there's two ways to qualify for that 50% deduction. The first way is the option was issued not in the money. This one is issued in the money, so does not qualify for the 50% deduction. So in order to get the 50% deduction, not in the money, or if it's a CCPC, held shares for 2 years minimum. So if we think about this example here, she bought the shares in 2023, and then she sold them in 2024. So did not meet the 2-year minimum. And also the option was granted in the money, so did not meet this condition. And there's an or statement also, and did not meet this condition. So they do not get any deduction. So then the taxable income would have increased also by 21.5. So that's the difference with a CCPC. Everything is deferred until the year the shares are sold. And the only other difference is that if you don't qualify for the 50% deduction because the option was granted in the money. There is another way to qualify for it if it is a CCPC that issued the stock option to you, but you would have to have held the shares for at least 2 years. In this case, they did not. But the overall increase to taxable income, 21.5, would be the same as Part B, but it's just a timing difference. So we go back to Part B. 21,000 in 2023, 24,000, or sorry, 500 in 2024. So 21.5 is the overall increase to taxable income over the 2 years in Part B. But if it was a CCPC, everything would just be deferred until the year the shares are sold. Any questions about that example? The one thing that I want to talk about on the last part of this handout is those new stock option rules. This is sort of what I cut and paste from earlier. This is talked about on page 169 of your textbook. And these are for stock options that are granted beginning July 1st, 2021. There's sort of been a lot of Canadians not happy with these stock option rules. When we think about how these stock option rules work, generally they're only offered to senior executives. So those executives that are already making quite a bit of money, and the purpose is that they buy the shares will increase in value, and they'll sell them for a gain of which 50% is taxable. But the one thing that you'll sort of notice is that because most stock options are granted not in the money, even though they have to include this amount in net employment income, they get a 50% deduction. And so only 50% of the increase in value is going to be taxable. So a lot of Canadians says, well, that's really not fair. You're basically, again, crafting these rules to cater to those that are wealthier, because stock options will usually only go to senior executives. They're making a little bit, quite a bit of money already. And so you're only taxing them on 50% of the employment income inclusion. And then when they sell the shares at a gain, only 50% of that capital gain will be taxable. So in sort of, because of all this sort of resistance or dissatisfaction with these stock option rules, the government introduced these rules that came into effect July 1st, 2021. Now, these new rules will not apply to CCPCs. So once again, the government is saying if you're a Canadian-controlled private corporation, then these new rules will not apply to you and your employees. The rules will also not apply if you are a non-CCPC and your gross revenue is 500 million or less. So what they're saying is that if you're not a CCPC, maybe you're a public company, the rules will only apply if your gross revenue is over 500 million. So it has to be sort of a really big public company or non-CCPC in order for these rules to apply. And if we look at the question that we just did, it said that this company had gross revenues of 190 million. So that was sort of relevant in that these new rules will not apply to this company because their gross revenues was 190 million, and these new rules will not apply. Oh, where did it go? These new rules will not apply if your gross revenue is 500 million or less. So 190 million, they were below the threshold, so these new rules do not apply. Now, this sort of ties to the fact that the tax rules are always changing. That's why this particular textbook, there's a new edition every September, because the rules are always changing. And the rules are probably even different from some of the rules that are in the textbook that we are currently using. So one thing that I always tell students is that if you're thinking about a career in accounting, tax is one of the fields where the rules are always changing. And so there's always going to be quite a strong demand for tax practitioners because the rules are always changing. It's really only the tax accountants and the tax specialists that keep up with all these rules. And the clients will be always wanting to make sure that they're on side with the tax rules. So that's sort of where I found when I was working in public practice, there was always sort of a demand for tax services, more so than maybe other services that an accounting firm may offer. So if you're sort of thinking about where you may want to specialize your career, I think tax is one of those areas that are always going to be sort of in demand because the rules are always changing. Even if you're planning to maybe go in financial planning, there could be a focus that you have on tax within your financial planning practice, understanding the well, rather than the investment side. So just something to think about when you're sort of thinking about where you want to take your career. So what are these new rules? If your company that gives you the stock option is not a CCPC and their gross revenue is over 500 million, then your annual limit per employer is 200,000. And we'll sort of go through this example and talk about what that means. So we have this example here where on September 2022, Manaz was granted a stock option to acquire 100,000 shares at $20 per share. Current fair market value is 16, so not in the money. That's the common type of stock option. It will generally always be not in the money. The options can be exercised starting next year, and his employer is a non-CCPC, and the gross revenues are in excess of 500 million. So the new rules will apply. So what happens then is this is the grant date. We know that the shares, the option was granted not in the money. So that's one thing that we did from the earlier example. But also on the grant date, we have to determine what we refer to as the qualifying shares. And this is sort of where that 200,000 annual limit comes in. We determine the qualifying shares, meaning the shares that will qualify for the 50% deduction. So how do we determine that? So what we do is we take the total fair market value on the grant date. So option to buy 100,000 shares. At that time, the fair market value was $16 per share. So we have 1.6 million based on the fair market value. Now, the qualifying shares will be 200,000 of that. So every employer, you get this $200,000 annual limit. So Manaz is going to get this $200,000 annual limit. And so 200,000 over 1.6 million, that's going to be 12.5%. So what that means is 12.5% of the number of shares will be what we consider qualifying shares. So what is 12.5% times the 100,000 shares that the option gives him the ability to buy? That's 12,500 shares are considered qualifying shares. So this is just done on the grant date. If he never exercises the stock option, doesn't matter because this is just on the grant date. So let's say next year he does exercise the stock option. He buys all 100,000 shares at a price of 22. So the fair market value has gone up to 22. So then we have to figure out his employment income inclusion. But before we do that, he's going to purchase 100,000 shares, of which 12,500 are qualifying. And the remainder, 87,500, are non-qualifying. So then we said that we have to calculate that employment income inclusion. So same calculation, we take 100,000 shares difference between what the fair market is when he exercised the stock option, 22, minus what he paid. He paid again $20, so a difference of $2. So his employment income inclusion is going to be 200,000. This is part of 3A when he calculates his net employment income. And so once again, his net income for tax purposes will increase by this 200,000. And then the question is, how much will he get for the 50% stock option deduction? And this again is where we look at the number of qualifying shares. So this calculation here, I'll put this on the side here. He only has 12,500 qualifying shares. And so the 50% will just be based on the 12,500. So the net employment income inclusion was 22 minus 20. So this 100,000 included all the qualifying and non-qualifying. But for the 50% stock option deduction, only 12,500 will qualify for the 50% deduction. So what we do then is we take the difference between the fair market value, 22 minus what he paid, 20 times the 12,500. And that's going to be basically 25,000. So only 50% of that will qualify for the deduction. So let me just sort of show this another way. I'll show this sort of another way, which might make it easier to comprehend. So this 100,000 here, we can break it down. We can say 12,500 times 22 minus 20, and then 87,500 times 22 minus 20. And so the first one will be 25,000. And then the second amount is going to be 175,000. And so that's how we get the 200,000. So we just sort of break it down between the qualifying and non-qualifying, but it's going to work out to 200,000. But only 50% of the qualifying shares, which is the 12,500 times $2. So only 50% of the 25,000 will qualify for the 50% deduction. So that means a deduction of only 12,500. So the taxable income will increase by 187,500. Any questions about how we came up with the qualifying shares or how we came up with the 50% stock option deduction for this example?
It's not a question necessarily about that, but at the top it says 200,000 per each employer. So in theory, they could deduct like if they had more than one employer, or what does that imply?
So you're totally right. So what it basically is saying is that, let's say Manaz was also employed by another company, ABC Limited. And ABC Limited is also a non-CCPC with gross revenues over 500 million. And he was given a stock option by ABC. Then he could also do the same calculations using the 200,000 over the fair market value of the option that that other employer gave him as well. So you can do this calculation for each different employer you have that gives you a stock option.
Okay, sounds good. Thanks.
Okay, you're welcome. Any other questions? Yeah, so that's a good question because it's per employer. And, you know, in reality, most executives will probably just have one employer. But if they had more than one employer and they got stock options from different employers, then they could use that 200,000 for each employer. And there's an annual amount. So if they get a stock option next year, they can use that 200,000 again because it's an annual amount. So then the last part of this example, let's find it here. He sells the shares. So in January 2024, he's going to sell all 100,000 shares at $30 per share. And so just to sort of wrap up this example, we have proceeds of disposition. He's going to sell all 100,000 shares at $30 per share. And so his proceeds is going to be $3 million. Adjusted cost base. And so once again, what is his adjusted cost base? So we have to go back up to when he exercised the stock option. So remember, he used this $22 as the fair market value. So he had to include the difference between 22 and 20. So even though he paid 20, he's going to get the full benefit of the 22 for his adjusted cost base. So the adjusted cost base will be 2,200,000. So the capital gain will be 800,000. We multiply that by 50%. The taxable capital gain will be 400,000, and that's included in 3B when he calculates his net income for tax purposes. Any questions about these new stock option rules? They're not necessarily new. They came into effect, like I mentioned, July 2021. But any questions about these rules? So that brings us, I believe, to the end of this handout. It does. What I want to do is just sort of bring up eLearn quickly. So let me just quickly see if I have eLearn open. So I was going to bring up eLearn quickly and just sort of talk a little bit about what we're going to be doing next week. So this is the course eLearn page, and we've gone through, last week was chapters 1 and 2. This week, chapter 3. Now, right in the middle here of chapter 3, there's this new chapter 3 employment expense handout. This one right here, I'm hovering my mouse over it. We did the first one today, the Word document. This Excel document, we'll start with that next week. So this chapter 3 employment expense handout, we'll start with that next week. And then we'll start with the chapter 4 handout. So next week, we'll finish chapter 3 and we'll start chapter 4. And then chapter 4 will take us to January 29th. And then the first midterm will be the week after, which will be February the 5th. So just sort of keep that in mind. First midterm is February the 5th during class time. It will be on eLearn. And I'll give you more details about that when we get closer to the midterm date, but it will cover chapters 1, 2, 3, and 4. The chapter 1 and 2 homework is due this Sunday. Chapter 3 homework will be due Sunday, January 26th, and then the chapter 4 homework due Sunday, February the 4th. So make sure you get the first homework done by this Sunday. There's only one attempt for the homework, but there's no time limit. So you can go in, look at the questions, just make sure that you input your answers and submit the quiz before the due date. And then on the Monday, the answers and marks will be released. I think that was it for today. Yeah, that was it for today. Any questions before we wrap up? As I just heard, yeah, go ahead.
Oh, no, I just wanted to say thank you. No questions.
Okay, you're welcome. I was going to just check again, any sort of feedback? I know that we've had 2 classes last week. Everyone sort of mentioned that the pace was good. Any sort of feedback after today's lecture? Was the pace okay? Any feedback, if you want to just type it quickly into the chat. Any thoughts about things that worked well, maybe things that you might want to see going forward? If you do have any feedback, if you want to just sort of type it quickly into the chat before we wrap up, or if you prefer, you can always just sort of drop me an email if you prefer that as well. Yeah, so that is it. I don't see any questions coming up. So having the notes handout is nice to follow along. Okay, that's good. So if you do have any questions or you want to meet me during office hours, just drop me an email. If you have any questions while you're studying, just email me rather than try to wait till the day of the class. That way you can get your questions answered sooner. And that is it for tonight. So what I will do then is I'll post the completed handout on eLearn. And once the recording becomes available, I will also post that link on eLearn as well. Okay, that is it for tonight. Have a